Grateful for your early rise. Brent crude oil trading this morning, essentially, I would say unchanged as of yet. Still holding the gains, one would say, at 66.90 on Brent. WTI a little less than $2 back. A gap between WTI and Brent seems to be closing all the time. But of course, the big news overnight is that US and China officials agree plan. That is sort of nebulous word. It's a deal, but exactly the terms of which are really where the real information is. Let's kick off this morning with Nadia Martin Wigan, a director at Svelland Capital. Nadia, sitting in Norway, your thoughts on whether this agreement, the fact that obviously the Chinese and the US went into these talks in London, it would appear with most of the I's dotted and T's crossed, that this will be enough now to propel Brent crude oil up to the holy grail again of $70 a barrel. Your thoughts?
Good morning. Well, we don't have the details yet on how these trade talks have progressed. And for the oil market, it matters a lot what is the general framework and tone, as well as a willingness to create exemptions and exceptions. And what we've seen with the whole trade balance is, of course, oil, LNG, LPG. These are the ways that China can improve that trade balance. So the oil market really wants to see progress there. So far, we have ethane, which is exempted from the tariffs on the Chinese side. We would love to see other US oil products to be included in that.
Well, they certainly seem to have maintained, at least publicly, a continued disruption of the LNG exports. Let's go to Paris, where we have Neil Atkinson, the former head of oil marketing's division at International Energy Agency. Neil, your thoughts? I mean, the oil markets have been climbing for the last few days. A little pause this morning in early Asian trade, but nonetheless, the idea that the US and China were finding alignment does seem to be pleasing the oil markets and giving confidence to go higher and higher up to 60s, knocking towards the door of 70. Is this enough? Will this take us back to where we were before the sort of big dramatic announcements, the Liberation Day of April 2nd?
Well, I think what we're now seeing is that all the noise and bluster around Liberation Day, as time has gone by, has given way to calmer heads and a realization that things really do need to settle down. And the news from the US-China talks is obviously very good. It's a vastly important relationship, and we must all hope that there is some kind of coherent agreement which takes us away from the bluster of Liberation Day. And then beyond US-China, of course, there's US-European Union, there's US trade relationships with a whole host of other countries who Trump tells us are all begging to strike a deal with him soon. So it does look as if things are settling down tentatively on the trade front, and that must be good. But I think what we also need to be looking at is, meanwhile, back in the fundamentals of the oil market, things are beginning to change there as well, gradually. And of course, we'll come on in more detail, perhaps, to talk about the outlook for US oil production, and of course, where we think oil demand might be heading. So things, I think, are beginning gradually, after the turmoil and the upheaval we've seen since Trump came back into office, some kind of sense that things might be settling down to something close to normality.
As the streets of LA burn with the Marines going in to beat up on American citizens, normality is a different relativity these days, it seems.
Yeah, but that's not an oil market issue.
No, it's not. Not yet, perhaps.
I take it.
Gaurav Sharma, journalist and energy analyst, your thoughts on the same theme, this upward momentum of oil prices. It seems it started with after Trump's visit to the Gulf. Prior to that, oil prices were falling. There was a much more bearish tone. Increases from OPEC Plus were shocking the market downwards. Now, the same narrative in terms of outlook of increased OPEC Plus supply, this deal with China. Is this the continued momentum? Will we see more movement? Or is this sort of buy on the rumor, sell on the news thing?
I think we're good to be back. I think we're back to ranges we saw before the tariff kerfuffle sort of began. So prices have merely clawed back to levels they were before Mr. Trump kicked all of this off early April. Now, what we have here is a situation that OPEC is raising production or trying to claw back the additional 2.2 million that the 8 members promised. You have a situation whereby which OPEC is raising production. US production is sort of hedged depending on which player you talk to with outwards 6 to 12 months. So there's a whole lot more oil coming onto the market. Now, will it be a repeat of 2016, 2015, 2016, whereby which it's a fight for market share and few people will take a few blows? I think so. I think there's a lot more oil coming onto the market. Now, in terms of demand growth, we had sort of, depending on which data aggregator you rely on, we're talking north of 1 million barrels per day in demand growth. That was already, prior to all this happening in April, could still have been serviced by non-OPEC production alone. So if we factor all of that into thinking there's a whole lot more oil coming onto the market, I'm not terribly bullish on oil prices right now at all.
The idea that oil markets, Nadia, are range bound, there's nothing, despite the swing we saw, Brent dipping below 60 and now trying to knock on the door of 67, that is it your sense too that we are range bound, that these are not dramatic enough events, i.e. U.S. peace or the peace agreement, U.S. trade agreement with China, maybe it's peace as well, we'll see, but that these events are not sufficient to propel it into a new sort of paradigm?
Well, we have been, as you say, in a very tight range. And right now, we don't have enough detail, I think, on the China-US progress for the market to truly assess this change. I mean, since Trump,
I suppose ultimately it doesn't change.
It's been quite a negative range and feeling with these additional tariffs and the general positioning in the oil market. When you look at speculative positioning on the bulls versus the bears, has been tilted towards the bearish side, and algorithmic traders, except for the very short-term traders, keep receiving sell signals based on where we are in terms of price movements. We've broken through the 50-day moving average, so your very short-term algorithmic traders have received a positive signal, so they can be more on the buying side, but it's not enough to completely change the fundamentals and that feeling. And this is when we look at the shipping market, it's another indicator of where the market has been short since the Trump election and continued to be because of concerns over tariffs. Now, when we see that really make a seismic shift to the bullish side, then we know that the market has decided the worst is behind us and we have clarity on these tariffs that we can continue going forward. In the meantime, however, actual oil demand has been very strong, and that's been led by strength in Europe, relative to the expectations that the market had in the second half of last year when we started that downtrend. The expectations were that we were going to have massive stock builds. And we're still in a pretty low, historically driven inventory situation, especially on the crude side. Japan is built in the last week, but they have 900,000 barrels per day of refinery maintenance right now, including outages, unplanned outages. But overall, we're in a strong situation in terms of low inventories going into peak demand season at a time when OPEC has already 3 times announced that they're going to do much faster than expected cuts. And we've yet to see a single barrel of that oil hit the water and be visible beyond the cheating that we've seen from the countries for the last 6 months.
Neil, this sort of negotiation between the Chinese and the US about the idea of special minerals going out of the rare earth minerals going out of China back to the US, opening up some of these very specific items, but ultimately regardless of what's in the detail of this agreement, it doesn't change the fundamentals that China is suffering a kind of a weaker economic cycle. Stagflation seems to be very clearly bedding in there. That this maybe doesn't stops it from being a much worse challenge for China, but ultimately China is the world's biggest oil importer, second biggest economy, continues to be in a weak space.
Yes, just very quickly, you used or asked the question, are we range bound as far as oil prices are concerned? To which my response is, I hope so. When I worked in the industry, we used to love things being range bound. It depended which range you were in, needless to say. But if we're in this current sort of range,
plus or minus 65 on Brent seems to be where we've been at. We haven't quite broken it.
It's a sweet spot, you know. It's demand, as Nadia was saying, is, I think, underlying demand is probably stronger than we've been giving it credit for in the early part of this year. Everybody rushed around Liberation Day and the early Trump disruption. Oh, oil demand is going to be X 100,000 barrels a day lower than we previously thought. And I think that's not likely to turn out to be the case, or quite as damaging as was the case. So if we are range bound at this level, that's great. It's not bad for consumers. These are not unbearable prices for consumers by any means. And for a lot of producers, they're pretty good too. Anyway, back to China. Yes, you're right. I mean, China, obviously, after 30 odd years of breakneck economic growth, is showing signs of slowing down, of taking a huge pause. There's a lot of overcapacity in very many important parts of the Chinese economy, not least, of course, housing, but also in some of the industrial sectors. And we're starting to see an impact, still debatable, but an impact on things like gasoline demand from electric vehicles, and not just in passenger vehicles, but in some of the trucking sectors and elsewhere. So China is, if you like, entering into a mature phase, having gone through breakneck growth for 30 odd years, and we're starting to see transitions within the Chinese energy sector, and that is going to have long-term implications for the oil industry, of course. That's needless to say. But I don't think we should yet call a definitive peak for Chinese oil demand, which some analysts out there are doing, and I have great respect for that, because China's.
Well, even the Chinese themselves, the biggest oil companies, they are saying we're in peak mobility fuels, maybe not peak crude.
Right. They may be right. Yeah, absolutely. But even though the EV sales in China are, of course, very strong, and that's easy to achieve in a command economy where you've got various subsidies and incentives for people to use them, but they are also still selling a very large number of internal combustion engine vehicles. And the Chinese are still going to see growth in the aviation sector. Shipping to and from China, not just talking about oil imports here, is going to remain strong over the years to come as their economy does grow, albeit perhaps at lower than the previous expected levels. Consumer demand could pick up, and that would imply stuff, plastics. So, I'm not yet ready to call a definitive peak for Chinese demand, although I respect the views of some that suggest that in the certain mobility sectors we might be getting close. That's true. But the US-China trade agreement, whatever form it does eventually take, and I think Nadia was suggesting earlier on, we haven't seen anything yet, any great details. But if there are details and something is signed and a couple of guys sit there under a flag with a pen and write their names on a piece of paper, then I think we'll be very, very happy. And that will give a strong underpinning to the growth of the global economy this year. And in turn, that will give some underpinning and some certainty to trade in oil, whether it be crude oil or products, and of course LNG, which was mentioned earlier on, which is a very, very important sector, particularly for US exporters.
Gaurav, just picking up on the point there mentioned by Nadia, that the data, the OPEC plus increase in production quotas over the last few months has not resulted in any real barrels, because the quote unquote cheating or the overproduction was of such a scale that the quotas are still catching up with production. Your thoughts on that? And if that is the case, where are the secondary resources that have been so-called telling us for the last period of time? I mean, where are the data? Where is the incorrect source, or where is the correct source of data? Is OPEC Plus? Is it all of the secondary sources, Kepler and Platts and everybody who's reporting these numbers every week, every month? Where is the breakdown?
Look, the aggregators have been telling us for a while that there's been, been some cheating. I can't use any other expression. That OPEC has been, OPEC players and OPEC Plus players have been doing it for a while. Now, the Saudis have made a point in particular to very, well, not overtly, but well, kind of overtly, but said that, we need to get our own house in order, and that they're not.
Sorry to interrupt, but we've added back over 1 million barrels of quotas. Are you telling me that I don't remember seeing any secondary sources saying we were over 1 million barrels of busting, cheating, non-compliance, call it what you will.
Not necessarily, but if you look at this data-driven world, so, what has not percolated through the public discourse may not necessarily reflect on the ground. I'm not saying anything untoward, but I do say that some of these data aggregators are clients of the powers that be. That said, everybody's known in the analyst community that there has been some busting, some production busting going on for quite some time. Now, Nadia is right. These additional 411,000 kbpt, that hasn't sort of percolated through to the wider discourse. It will in the fullness of time. But what I would like to add here is Neil is absolutely right. We shouldn't just assume that the peak demand is here. That is a fair bit of nonsense. Even
he
if
said peak demand China,
peak demand in China, indeed, because you just don't look at human mobility. There are other pillars of it, aviation and petrochemicals, huge, large pillars that we will bank on. The difference between 2016 and right now, when this whole OPEC versus shale stuff has started yet again, is that back then you had 3 of the big 5 taking in more crude. Right now, it all seems to be, at least in public discourse, that India is the only one of the big 5 major consumers that's turning more to the market than it did at this point last year. That alone would not sustain itself. And don't forget that shale is driven by the spirit of private enterprise. And now the likes of Exxon and the big oil companies have huge stakes in the shale plays. And they're saying they'll keep going even at $50. And some of the smaller ones are hedged for the next 6 months. So there's a whole lot more oil coming out, especially light sweet crude.
Let's get the survey question in and get a view on the room in terms of the significance of this China trade agreement. U.S.-China trade agreement will propel Brent crude to $70 a barrel. Agree or disagree? We're missing the word U.S. ahead of that China word there, but U.S.-China trade agreement will propel Brent crude to $70 a barrel. Agree or disagree? Will it be the opposite, that this is now the high water mark and we will head south? Agree or disagree on that one? Nadia, one thing you can't disagree with is the fact that the World Bank came out yesterday with their mid-year report and downgraded global economic growth to just 2.3%, the lowest since the global financial crisis to 2025, putting aside the dramas of COVID. Yet the oil markets didn't even respond. They stopped going up maybe, but ultimately world economic growth down to 2.3%, worse since the world financial crisis, and oil markets don't react. Your thoughts, A, on the World Bank report, B, on the lack of reaction?
I think the World Bank is reflecting what the market already thought. We have the price response. So they had already expected a much lower, slower number, and the World Bank is catching up to what the markets had already priced in. And of course, we have to remember that oil markets, they trade month to month. And right now, refinery margins are great. The market is clearing. It's tight on the sour side. We have a lot, we have Canadian outages and forest fires. We have Venezuelan oil that is increasingly going to be tough to load, given that Trump did not extend, the freedoms to continue pushing that. We have concerns about Iran because that agreement has not been signed. The latest I've seen is that the Iranians are not happy with the terms. So there is a lot more uncertainty. And I think the biggest one to me is the fact that when we think about a potential price war with OPEC, well, a part of that is Saudi Arabia, that yes, we are hitting peak demand and exports and parts of that. But in our view, Russia's sitting on 500,000 barrels per day of spare capacity. So a real volume price war led by OPEC would depend on an increase in Russian exports. And right now we have the EU proposing that the price cap be brought down to below to $45 a barrel from 60. Let's see if that actually holds water. But that would make things much tougher economically for Russia to ramp up. Historically, yes, they have the lowest cost of production. We thought until the COVID price war, when we saw that Saudi Arabia was the last producer standing, not Russia. And so that is a big difference. Saudi Arabia, of course, could do this themselves, but the Gulf producers have really maintained that partnership with Russia is very important. So right now it's looking more like a tepid, let's put in some more barrels officially. Let's see if the price holds. Well, it's holding. It's going up. So we're clearly doing the right thing at a time when some, as Gaurav says, some marginal producers in the US are already getting hit. And most importantly, next year's production is in question for the US. And that's where we have production declining the second half of next year. And then, OPEC may not need to cut as drastically as the market has been expecting. So things are going more slowly and more orderly.
Neil, on that point, I mean, we had the reports overnight, the EIA, that they see declining U.S. production next year. I mean, in the old adage that the cure for lower prices is lower prices. Whatever the intention of these of this current window to raise supply by OPEC plus, led by Saudi Arabia, to as wide reporting and analysis is, to put a squeeze on the non-complying OPEC plus members, but also it would appear a squeeze on the wider higher cost producers globally. The trickle-through impact of this window of time as OPEC continues with this strategy, expected to increase again next month. Your outlook for how that will squeeze the US and other higher cost producers around the world. Will we see the EIA revise even greater downward?
Just before we get to that, secondary source.
Yeah.
I've been in and around the secondary source industry, so to speak, for 40 years. When I worked for Petroleos de Venezuela, one of my jobs in the London office was to mislead the market about how much the company was producing because it was busting its quota. And in subsequent roles, I've been on the other side of the fence. The secondary sources do not know what production is, wellhead production. They do not know. They know what exports are because that's visible. Most of it from these countries goes on ships, and they can work that out. They have estimates as to what the domestic refining industry will consume in terms of crude. They add the two numbers together, a bit of intelligence, they chat to a friend that they know, and they come up with a number. Now, it's still, even with the wonders of modern satellite technology, still an imprecise art. So we don't know. What we do know, and I think this is way more important than the 411,000 barrels a day, is what is happening with exports. And exports are not rising. So oil supplied to the market, which ultimately is what really matters, is not increasing visibly. And we'll get an update on the main numbers. So I think we need to make a distinction here between secondary source production estimates and actual reality as far as export volumes are concerned, because they're not the same thing. Now, as far as the US is concerned, yes, I've been reading the FT story, and I read some data from Bloomberg this morning before I came on the show, and it does look as if, given that the US industry is now much more heavily controlled by big, serious majors like Chevron and Exxon and Conoco, who take sensible long-term decisions, it does look as if we are going to see a pullback from any kind of growth for its own sake that we might have seen 10 or 15, 20 years ago. So yes, there is a reaction because prices are lower. Drilling activity is definitely down. The numbers are there in front of us, but there's still a big difference in what we're expecting. The EIA number, which I think we mentioned earlier on, they show production down by 200,000 barrels a day by the end of 2026, which in the great scheme of things with rounding and everything else is not actually a big deal. However, Standard and
At least
Poor's—
it's some reflection it's not rising anymore after
Oh,
a
that's
few
true.
years.
That's a fair point. Standard and Poor's, on the other hand, are looking for a decline of 600,000 barrels a day by the end of 2026. So there's still a lot out there. And the other point to mention is that, and Bloomberg mentioned this in their piece, that while the shale sector may see a decline, and as you say, at the very least, not grow, Gulf of Mexico, I think sitting in France, I'm safe to use that phrase still. Gulf of Mexico production is actually going to grow to record highs. So the US remains very interesting. There's still a lot of investment going on around the whole of the US sector. We'll just have to wait and see how it plays out. But if I was OPEC or OPEC Plus, I'd be looking at this and thinking, yeah, you know what? These guys are going to perhaps hit a peak, which may be temporary in the next year or two. Obviously, there are other factors which Nadia mentioned about maybe we will see more Iranian barrels coming into the market if there's some kind of nuclear deal. Sanctions against Venezuela is another factor as well. And she was absolutely spot on to highlight the role of Russia. Well, and by the way, thank you for reminding me of the existence of the price cap. I'd completely forgotten it existed. I mean, but thanks for waking me up on that point.
The price cap of $60 on Russian euros.
I suppose a success that's been. Yeah.
It exists if indeed the wider market is above that. It seems that we've been with the dynamics of the market in recent months that hasn't been as great an issue. Gaurav, last word to you as we look forward to some of these developments. I mean, we have. Obviously, this in the front and immediate, the Chinese-US agreement or whatever they have agreed at some sort of a progress on that front. But the greater pressure of time, because the Chinese-US 90-day suspended thing is to run till August or something, whereas the rest of the world is in a 90-day window in which we're coming to the end of in June of suspended retaliatory tariffs, as the US have called them, when the big dramas of April 2nd will resurface. And yet we don't see the same momentum as we're seeing with US-China trade talks with anybody else. Anybody else you talk to seems to have a common response that it's not clear what the US wants from us, i.e. that's been a refrain from Japan and to a certain extent from the Europeans. Your thought of everybody else, where the trade talks go with everybody else, how damning or damaging does that still remain for all markets?
Look, damaging in a sense that it's Trump is a performer. At 1 minute it's one thing, another minute it's another thing. They started in April with sort of blanket tariffs on the whole world. Then you claw back. Then again, there's a toing and froing between the Europeans and the Americans and the Canadians, the Americans and Chinese. This show will go on because Trump is playing to his own constituency. Its implications for the oil market, yes, it is bearish in a sense that this will serve to be a drag on prices. But at the moment, agreement or no agreement, it is now manifestly apparent that Mr. Trump says one thing, then retreats a bit, then slaps further threats on, and this toing and froing will go on for heaven knows, probably for at least for this year or even for the duration of his presidency. It's something the oil markets have to get used to. And I think it serves as a drag, but after a point in time, traders become a little thick-skinned, saying, well, this is going to go on. Let's look at the real tangible demand, where global economic performance will come in. Mr. Trump will cast a cloud on it, but real economic activity will percolate through to traders' psyche. Even with that, I still am not terribly bullish at the moment.
I suppose even whatever they've agreed in the UK, China, US negotiators, as you said, it's only we're hours away from the next kind of shock awe that is the my hair is on fire Trump administration. Agree 44%, disagree 56% that this agreement will propel us to $70 a barrel. That's closer than I thought that answer would be, which is good. I always like when there's close answers. But there is certainly sense that, what will the China-US stress? Because that does seem to be exposed to a much greater sort of era-defining stressful relationship that is not going to be resolved by a few rare earth minerals, but let's see in the short term. Nadia Martin Wigan, thank you so much. Great to have your voice at the table all the way from Norway. Neil Atkinson in Paris, Gaurav Sharma in London. It is the European Powerhouse panel. Thank you guys so much for getting up very early, not too early, I suppose. It is summertime. You got to get up out of bed, enjoy that long day of light that starts early and finishes late. And it is the wonderful time of year to be in Europe. All the best. Have a great week, everybody. Thank you.
Thank you. Thank you.